So you heard about fixed income yesterday, and today we're going to talk about equities, and then we're going to talk a little bit about asset allocation and how you put that together. And I've got a lot to cover here, so I am going to be moving pretty quickly on this, and I will be here afterward for almost as long as you want to answer any questions that we don't get answered. But this is kind of what we're going to cover. What's the stock market, types of investments in the stock market, costs, professional management information sources, performance, and issues. So the stock, I stole a couple of these slides from somebody else who does this presentation, and I like this zoo. The stock market is like a zoo. If you think of the market as a zoo, each animal representing a company or a stock, some have more value than others, so they're different prices, and the prices change moment to moment as somebody values one animal more than another. If a new animal is introduced, that's an IPO.
What does IPO stand for?
Initial public offering, when a company first goes public and is available, offering shares for the public to buy. Owners can buy or sell, and you could use a broker, an animal broker, or you could use a consultant. And we'll kind of get into that a little bit more as we dig in. So general types of equity investments include stocks. Stocks are the most basic form and used to be really the only form. And stock represents ownership in a company. In the old days, you used to actually get stock certificates. And some people still have those. And by the way, anybody who does have those in safe deposit boxes somewhere, we always recommend that you get them into a brokerage house where they're safe and have some degree of insurance. And it makes it much easier if something happens to you. It's very hard to transfer stocks these days from stock certificates. Mutual funds are a basket of stocks that are professionally managed. And mutual funds will have different objectives. We'll talk about mutual funds a bit more. But it's a group of stocks that has a manager buying and selling those stocks within that fund. So you could get a whole basket of stocks by buying one mutual fund. An index replicates a particular stock index, such as the Standard & Poor's 500 or the Dow Jones or the Gold Shares Index. There are indexes representing all different segments of the market, and you could buy the S&P 500 by buying an index fund, or there's a second way, the ETFs. If you buy an index fund, it's like a mutual fund, and it's a basket of those stocks, but it's not traded. It's just going to replicate the index. If stocks are pulled out of the index and new stocks are put in, the mutual fund will substitute the new stocks. Exchange-traded funds are relatively new within the last 20 years, and they've gotten more and more popular. There's a huge amount of money flowing into ETFs now, and that means exchange-traded funds. They originally started out as indexes that were traded like stocks rather than mutual funds. And the difference is a mutual fund is priced at the end of the day. So if you have 60 stocks in your mutual fund and you want to buy and sell a mutual fund during the day, you have to wait until the end of the day to get the price. After the market closes, then all those 60 stocks are tallied up and you can buy into it based on the price that day. The exchange-traded funds are different, and then they trade like a stock intraday. So that whole basket of stocks is being priced moment to moment in the market. And of course, the financial service industry has gotten in there and exploited the original idea of ETFs, which was a really cheap way to get exposure to the market that was very tax efficient. And now there's exchange-traded funds for everything. There's exchange-traded funds with really high expense ratios. And to give you an idea, a typical mutual fund expense ratio, which we'll drill down into in a minute, is about maybe 1.2%. And they go much higher than that. But an index fund may have a fee of 60 basis points. And you probably have heard about what a basis point is. 100 basis points is 1%, so 60 basis points is 0.6%. An exchange-traded fund may have a fee as low as 0.08%, 8 or 9 basis points, almost free. Because all they're doing is it's an electronic program and it buys and sells the index and trades it on the market. Very inexpensive. And we'll talk about the tax efficiency in a bit. So ETFs has become really popular, but there are ETFs with expense ratios over 1%, which is really pretty crazy. And there are exchange-traded funds that are not even index-based anymore. So stock prices are... the market cap, the value of stocks is based on the price times the number of shares outstanding. That is the way that you can put a value on a company. It's not necessarily the best way to value a company, but that's how the market values the company. If there are however hundreds of thousands of shares outstanding in the marketplace, that times the current price that the shares is selling for is called the market cap, or that's the value of the company. So that's like where you start to look at if you look at what some of these big companies are valued at. The market is generally broken down into three sectors: the small, the mid, and the large cap. And we'll talk about this when we talk about asset allocation. But I know in my firm we feel it's very important to break out the mid cap sector. Some companies just look at small or large and just slice the market that way. We think the mid cap sector is a very different tier of the market, and it's important to break them out separately and include all those pieces in your portfolio.
What is an example of a large cap?
Walmart, Apple.
Okay, mid cap, do you know? No? Or when is the large cap? Is that, how large can you be and then get to large cap?
10 billion and up, generally. This is the most common way that it's categorized. Some people use different measures, but generally 10 billion of value and up. Mid is 5 to 10. This is on the outline.
Okay.
And small is less than 5 billion. So many of the small cap companies you haven't probably heard of. And then there's micro caps, which may be under $1 billion or something like that. And some people break out micro caps as a certain market sector.
And why is this important?
Because they have different characteristics and different rates of return year to year. Small caps could greatly outperform large caps in a particular year, and we'll look at that too when we look at putting a portfolio together. Another thing about stocks is they have ticker symbols that are either 3 letters if they're traded on the New York Exchange, 4 letters if they're traded on the NASDAQ, and mutual funds have ticker symbols that are 5 characters long. So that's how you know it's a mutual fund. Mutual funds, as stocks do, have different characteristics. There's so many different ways to slice the investments. One is by size of the company, small, mid, large. Another is by value or growth, and we call that investing style, or that if we're looking at a manager who's picking stocks in one of those categories, that would be an investment style. So companies could be categorized either as value companies or growth companies. And generally, value companies are the ones that are selling at a discount, they're out of favor, they're the kind of companies that you might think you don't want to invest in because they are
Sears would be maybe a value. Apple may be a growth.
Apple would be a growth. And these change. You can see as companies change, they can switch sectors depending on how the companies are doing. A lot of the financials would be, most of the financial stocks would be in the value category today.
When you describe an investment manager, do you describe them using these terms?
Yep, they could be a large cap value manager, or they could be a mid cap growth manager. So there's lots of different ways that you can break up those sectors when you put together your portfolio.
Can you compare a large cap growth manager with a value small cap manager?
Not a good idea.
Why?
Because they have completely different objectives.
Okay.
So when you don't just compare 2 funds and take the one that has the best return. We'll talk about looking back on performance too.
Okay.
But you need to have all these different segments in your portfolio ideally.
Right. So this becomes really the terminology in the equity area.
So any stock, any mutual fund can be broken down into these categories. Unless it's an index fund where it's not unless it's buying the small cap growth index, it might not fit into that category.
And if you have any old Disney certificates, I think they're going to be of value someday. They're wonderful looking.
Have all the characters on them. Yes, very cool. So mutual funds, as we just touched on briefly, used to be broken down pretty cleanly into load and no load, kind of commission and no commission. Those lines have blurred a little bit because there are lots of different types of fees. Even mutual funds that are commonly referred to as no load may have what we call 12B1 fees attached. And 12B1 fees are an ongoing expense of a fund, just as that covers distribution and marketing and so on. Typical 12B1 fees are 0.25%. So even no-load funds could have 12B1 fees, so that's a little confusing. But generally there are A, B, and C share mutual funds. I think there's D also, but I'm not sure.
There's E, there's F.
Yeah, there's A shares were the original mutual funds that have a front-end load. In the old days, when I started out in the business in 1980, A share mutual funds had commissions starting at 8.5%. And I look back to 1980, 1981 when I was starting this business, and I just cannot imagine how anybody bought a mutual fund at 8.5% commission when you could get 18% in a money market account with no risk. It's crazy, but people were investing in the market in those days. Those days of interest rates are probably never coming back in my lifetime.
Would in a mutual fund, would the commission be expressed in the expense ratio?
No.
Okay, so the commission is on top of the expense ratio of the mutual fund. And that's why we recommend, if you're going to do it on your own, T. Rowe Price, USAA, or Vanguard, stick to those kinds of funds because they're low cost.
They all have expense ratios. You need to watch the expense ratio, but they may also have 12B1 fees and front and back end loads.
And this is why it's so important to know the objective, because the objective is exactly what Laura just had stated. They'll express the objective as large cap value. They'll express
or small cap blend, which maybe have some growth and some value.
So
the S&P 500 is a large cap blend. Kind of by definition, the S&P is about half value, about half growth.
So what you want to know is, in your own personal portfolio, in the equity area, how do you have your objectives? What do you have to make sure that your portfolio in the equity area is diversified?
And we see people all the time who may have a portfolio of 10 or 12 mutual funds and say, I'm diversified, and they're all large cap growth funds. So there's no diversification, no added diversification by having that many funds. A little bit because you have a different manager, but not the kind of diversification you really want. So mutual funds are tallied up the value every day after the market closes and all the stocks are added up. And you can buy shares, and the value of the number of shares times the price is how much the assets are and the value of the mutual fund. Again, end of day pricing. One just tricky thing that I don't think I address anywhere else is that mutual funds distribute dividends and capital gains, and those pass through to the investors. And you might think, oh, well, then it'd be a good idea to see when they're going to pay a distribution and buy in the day before. And that doesn't give you anything but a tax liability. So it's actually a bad idea to do that, not a good idea to do that, because the price will be reduced by the amount of the distribution at the same time it happens. So you'll end up with a lower price but more shares. Net effect, same amount of money, but maybe a tax hit if it's a taxable account. So you actually want to avoid buying in right before distribution. Funds typically make their distributions, their big distributions at the end of the year, starting around October. There used to be a lot of secrecy about what kind of distributions, because funds were afraid that you were actually going to sell their shares if a big distribution was coming. If you didn't actually have a gain based on your shares and when you bought or sold them, you might actually sell a fund if a big taxable hit was coming. So companies for a while weren't disclosing what was coming, but now I think most reputable fund companies are pretty good about being able to tell you pretty far in advance what's coming. And when they talk to the investment managers, they are providing us with that information proactively ahead of time, so we know what's coming and what to plan for. But you don't have a lot of control over that in the mutual funds. Again, back on the indexes then is another way that you could invest. You can buy there are indexes on anything. You can slice the market very thin. There are the big indexes like the S&P 500 the small cap index like the Russell 2000, all sorts of different kinds of indexes that you can buy if you don't believe that active managers can beat the market. And we're going to talk about that in a little bit. That's always a fun topic. So index costs are low because there is no stock picking. The manager isn't putting any skill into managing an index fund. And so yeah, the next page then is kind of an argument for passive investing. And that's what another term for buying index investments is passive, where you're not paying an investment manager to actively manage your funds, but you are in fact buying the indexes and doing passive investing. So this chart shows 3 different 5-year periods, 2003 through 7, 2004 through 8, 2005 through 9. So some very different markets in that period. And over these 5-year periods, with these different categories of stocks, we see how many managers underperformed the market. So, in the very worst case here, on the international stocks between 2005 and 2009, 89% underperformed the index. Only 11% of those managers beat the index.
That's why you always want to look at the index. Have you beaten the index? If you haven't beaten the index, you might as well go in the index, right?
So professional managers can't beat the index. Why we say, why do we think we can beat the index? Why do you think you can beat the index? So this is the philosophy that my firm adheres to 90% of the way. Sometimes we talk out both sides of our mouth because there are, I think, times in certain asset classes where maybe you can make some calls that could beat the index or beat the market. But generally, it is a loser's game to try to beat the market. Okay, and what is the whole financial services industry designed around? Telling you how you can beat the market. It just doesn't happen. And the chances of you picking the manager who's going to beat the market next 5-year cycle, the statistics on going back and seeing if you pick the best manager, how long they're the best manager, and how long they beat the market, there's no consistency. There's just no way to do it. You could take a contrarian theory and look at the managers who did the worst and didn't beat the market. Maybe they're going to do better next time. There's no correlation there. It's very random. So that's why we'll get into the asset allocation approach, which is so important, is picking the right asset classes. Picking whether you should be in small stocks versus large stocks is much more important.
When you say asset classes, is this what you mean by asset classes?
Those are asset classes. Bonds or stocks. The first decision is bonds or stocks. How much in stocks and how much in bonds.
Your asset allocation percentage.
Right, and we'll get into that in a bit more detail. And then breaking it down farther, okay, say I'm going to put 60% in stocks. Which kind of stocks do I want to put it in? How do you break that down? Picking small over large is much more important than picking the right small stocks or the right large stocks. It's a waste of time. And that's where most investment people spend their time, is analyzing all these companies. And it really doesn't pay off very much of the time. That's an outlook that is gaining some favor, but as you see, that the industry doesn't make as much money with that kind of a pitch. The industry wants to sell you on the fact that they have some secret sauce, some special knowledge where they can beat the market. I mean, that is the name of the game. And it is so, when we look at the portfolios of the Goldman Sachs, the JP Morgans, nobody does any better than anybody else over time.
Nobody really has a secret sauce, but they all want to convince you.
And they'll show you
yes.
this great portfolio, and they'll pick out of the 85 different funds, they'll pick the 5 that did well the last 5-year period when they present the performance to you. I mean, it's such a cherry-picking game, and it just doesn't hold up.
And if they show you the formula, they'll have 2 lawyers on each side telling you that you have to sign a full disclosure form that you will not tell anybody about that secret sauce. It is a total mind game. And people actually believe that hedge funds are better, and then people who are the super wealthy have access to the guys who really know the secret sauce formula. and it's a joke. How much money, what's the, I know you've handled over $100 million estates, and was there any secret sauce there?
No.
No.
Luck was probably the best
Yes.
way that people. And the guy, the hedge fund guy who just got indicted, I can't say his last name. You know, they said the reason that they did well for so long was, you know, illegal insider information. It wasn't because of any special skill. So, you know, there's a lot of risk in the hedge funds because there's a lot of strange things that go on.
And if you have somebody who leads a particular industry, let's say they were in healthcare, in the upper echelon of that care, and he or she starts up a hedge fund, more than likely he or she has access to information that maybe us as a general public doesn't have. And they may have a slight edge, but that edge diminishes, boy. Every year that person.
You play by the rules.
Yeah, exactly, because you quote unquote can't do insider trading. But
and what we're going to end up, you know, I'm going to end up showing, you know, you can do well with a basic portfolio of index investments over time. Picking a good mix and sticking with it is such a good way to go.
So do you just crapshoot that mix?
yes.
No.
Well, kind of. I mean, you want to diversify. What I meant by crapshoot is that you don't put a bet on any particular sector or asset class.
Right. And there's, you know, the academic studies are really interesting. I mean, you can, and that's where we play around with, you know, tweaking the percentages between the asset class and try to add some value there. But it adds a little bit of value maybe, but not a lot of value. I mean, you can just do really well picking a mix and rebalancing every once in a while. And I'll give you some recommendations on the asset classes that you should consider.
But it's all about studying your own portfolio, okay? It's not out there, it's what you got.
And the tough part is the emotional part, which ties into the next slide coming up, is the discipline to stick with whatever philosophy you go with. Just slide number 9, just on the exchange traded funds. I think we've talked about that. The one comment before we move on the exchange traded funds is that, as I've said, they've exploded, and there are these enhanced exchange traded funds that use leverage where you could get the 3 times the Dow Jones up and down or whatever. They don't work the way they're supposed to. You can get whipsawed and lose a ton of money in those. I mean, they're really speculative trading vehicles. So ETFs is a really big universe, and it means a lot of different things. When I'm talking about ETFs, I'm talking about kind of the old-fashioned, though it's not a very old term, the core ETFs that invest in the basic indexes,
Stick
not
with
this
Hoover.
crazy stuff. Yeah.
Stick with Vanguard. Don't go to the Dyson model of the ETFs.
So the next page, the market's emotional roller coaster. This stuff is so interesting. Just, you know, the optimism turning into exhilaration, turning into euphoria, you know, and when people are just so positive, that's a really bad time to invest. Of course,
That's when my mother gets really excited.
I always say that we track everything in a database with our clients, and we can look back. I mean, you could read all the notes and figure out the day of the peak and the troughs of the market, but based on what people are doing. I mean, back to 2000, people were insane. I mean, people were, I mean, you all know stories of that, doing crazy things to put everything in Cisco, you know, mortgaging the house way beyond what they should have done to put it all in one tech stock. And then, you know, March of 2003, when everything was so gloomy, people were panicking, selling everything, not wanting to be in the market, and we love when that happens because that means we're going to have an up market. At the end of 2009, after all, when it was so bad, and it was scary and it was different, but things were so oversold and people were so panicked that it started, as horrible of a couple of years as it was, we started feeling pretty good as people got more panicky because it's always a turnaround. And of course, the market has come back stronger, faster than you know, almost anybody could have imagined.
And oversold, does that indicate a particular buy on a stock?
Yep. And it was a buy on the whole market. There wasn't anything that was, people got out of everything. So everything was, you know, oversold, meaning selling at really cheap prices when you looked at the fundamentals. And actually, I have a client who's the top woman at one of the top 20 companies in the country, very smart lady who was driving over some bridge in Europe saying, no, you don't understand, Laura, Walmart is going to go out of business. This is really, really bad. The world is ending. It's like, I want out of everything, just completely panicking. And it, it was scary and it was different. And next time it'll be something completely different. We can kind of prepare for something like what we went through this last time, but the next thing is going to be different. Risk is the thing that you don't see coming.
What did Michael say that from a securities bond point of view is a good area to invest in? That's kind of scary, and that's beaten down on the front pages. What did he say? Gosh. Mortgage-backed securities. He says that's, an area that we ought to be looking at for a percentage of our portfolio. Are they screaming on the front pages that mortgage-backed securities is the place to invest? No. In fact, that's why. It's out of favor.
I think Bob Veres did this thing for a while, which was the Financial Services Ad Index. So like whatever has the most ads in the financial magazines, that's the thing you want to be selling.
Sell it.
Yeah.
You as an individual.
And of course that's...
In other words, you don't want it. The more ads you see, that's the less you want it in your portfolio.
And the opposite is true, and it's really, really hard to do that emotionally. And that is, I think, the primary value of someone like me. I mean, what we're doing on the investment side is not that complex, because when you strip away all the games, it's pretty simple. But what we do is we have the discipline to follow our strategy and through all cycles, though there is room for difference. And my story on that I always tell is when things were really, really bad, and it was different than anything and very scary. I have this advisory board, a group of other advisors from around the country, combined manage billions of dollars, and we met right in the depths of the craziness, and people didn't know what was going to happen, and people were thinking of some pretty crazy strategies, and we had several midnight meetings at my office, and we were ready to pull off a good deal of our international exposure, and we don't do that. That is not a normal thing that we do. And we had all the trades written up, and we were all ready to go, and we were all sitting around the table, and as we were looking at the trade sheets, one by one, everybody said, well, I don't want to sell, don't put mine on there, and don't put my mom's account on there, and so-and-so, and everybody took their own off the table, because we knew it was a bad time to do it. I mean, you just don't sell at the bottom when things are so bad, and yet we were getting a lot of pressure from clients. And so I came out with a letter the next day, and I told everybody, this is what happened in our conference room last night. We were ready to do this, but when all of us realized that we didn't think it was the right thing for us, we knew it wasn't the right thing for our clients. But it's really, really hard to not, and it was the week of the bottom. And people who hung in there are well above those levels now.
It's to take that emotions out is so difficult.
And you look through everything that's happened over the last 100 years, lots of calamities and crazy things in the world, and if you have a good diversified mix of asset classes, you weather it all over the long term if you don't look at the short term. Professional management, so if you aren't going to do it yourself, you can look to mutual fund managers to buy the mutual funds, but then you need to make sure that you're getting a good mix of different types of mutual funds. There are lots of different tools for analyzing mutual funds. We'll touch on those in a bit. Or you can work with an advisor who may help you put together a portfolio of mutual funds, who may help you select individual managers, individual stocks, or different indexes in different asset classes. So there are different things that those different ways to go will provide you as far as different benefits of I think we have on there hand-holding with the advisor, right? Hand-holding, protect you from yourself.
I think that's one of the biggest, especially for the second spouse. I think when both spouses are alive, I think they talk to one another and they kind of keep each other balanced. But when one of the spouses dies, I recommend getting a fee-only advisor involved. You need somebody to bounce things off of who has, quote-unquote, your best interest at heart. And I think I would protect you from yourself as the number one. Prevent you from making that big mistake. And the 1% that it cost, that tweaking of the portfolio by 10 or 20%, they ought to provide some of that value back that you couldn't make on your own. And so to me, it's a very low-cost way of, of having somebody with you ferreting through this financial world.
And most financial advisors, even the ones that don't do really comprehensive financial planning, are usually able to give you basic advice on mortgages. Should you refi, 5-year interest only or 30-year fixed, pros and cons of that. It's just so helpful to have somebody to talk through those issues with. And
I got a phone call
advice.
last night and somebody promised me a 9% return. Good friend, I trust him. What do you think? Well, bring it on in. Let's take a look at it. It's having somebody there to just talk about your finances and have your back, so to speak, because nobody out there does. 95% of the people out there are trying to sell you stuff, and family and friends have no clue. Okay? Unless you're in this business. Okay.
So in selecting individual stocks or mutual funds that invest in certain types of stocks, there are different types of analysis that is done. And you can generally put it into 2 different categories, fundamental analysis and technical analysis. Technical analysis is a little fringy in the investment world. There are a large number of managers who use that, but I think the core investing philosophy that's taught in most of the business schools is more around the fundamental management, and as I said, even veering off into passive management and indexing over the last 10 years or so. Technical analysis is trying to predict what's going to happen in the market based on charting and certain patterns that happen. And there's some validity to that, but as soon as that information is out there and known by everybody, you kind of lose the value of it. Market timing involves a lot of technical analysis and looking at signals. And sometimes there are market timers that make a good call. But the trick with the market timing, which is where you may say, okay, my signals crossed over the moving average line and this happened, that happened, now I'm selling everything. And the trick is knowing when to get back in. So some people have made a call that might be pretty good on the getting out side, but if you don't get back in at the right time, you lose the value of that. And we've seen that time and time again. It's very, very difficult to try to call the market and time the market. I feel like I've learned that lesson over and over again. The longer I've done this, the more I feel not only can you not time it, but you cannot predict at all what's going to happen.
And they'll bring out
which is
charts.
not something that gives confidence to people I'm trying to get to put their money with me, but that's the truth of it.
Yeah,
and so we build a portfolio with that in mind.
Yeah, they'll bring out charts, a brand new computer software program invented and put together by this PhD, knows what they're doing, to say, we follow this as a discipline. And the same thing comes back as, yeah, maybe right once or twice, but coming back in and when are we going to have the next downturn? Do you know? We're going to have a downturn, by the way. I mean, it's going to be 25% or more. When is it going to be?
June.
June. And it happens in June. You're going to look like a hero. It just, nobody knows, but you know it's going to happen, and you got to be ready for it. And we don't know what sector, right?
Nope.
Used to think that banks were the safest place to be.
Well, they may be because they're so undervalued.
Yeah.
There's more.
No, before the crash.
Yeah, there's more to the contrarian theory than a lot of other ones. Buy the undervalued asset. Fundamental analysis is all these tools that you can use to analyze a particular company, and when you're analyzing the mutual funds, you can look at the mutual fund as a whole and look at some of these statistics. Price earnings ratio. There's a lot of different.
If you want to learn about this stuff and enjoy it, I used to be involved in an investment club, and this is really fun to do. But their National Association of Investment Clubs. Put a little IRA together for yourself for 10 to 20,000 and pick out stocks, buy and sell, have fun with it. Join a club if you want. It's only like $40 a year. They'll teach you about price earnings ratio. They'll teach you how to read, value line. Morningstar reports, and it's a lot of fun to do. But do it with just a small portion of your portfolio. See how you do over 3 years, and if you've beaten the indexes for the last 3 years, then you may want to venture out into your other portfolio and do it. But we're not here to teach you how to do this, but there are sources out there that will do so.
And just the last bullet on the fundamental analysis, if you own an individual stock, you should be able to explain why in 1 minute or less. That's what that says. 1 minute or less, why you own that stock.
Because if I sell it, I'll lose money.
Yeah, that's the idea of sunk cost is really, really important, especially on the individual stocks. Boy, do I see that time and time again, where people, they were going to wait till it gets back to where they bought it, which is not how you should decide whether you should buy or sell a stock.
3/4 of my portfolio, I'm waiting for it to come back.
There's a lot of risk in buying individual stocks. So the mutual fund selection process, Morningstar is the biggest research tool there. There's so much information available for free on the Morningstar site. Most advisors have a more robust
David Dudenhofer went through one of the Morningstar reports.
Perfect. So other sources of research, we use so many sources of research, and we do look at all the details and all, but I also think it's important to look at the bigger picture and read general news and kind of have a feel for what's going on in the world and trends if you're trying to kind of tweak your management of your portfolio and your asset classes. But it's just risky to think you know what's going to happen, to start thinking you know what's going to happen.
Allocation why?
Asset allocation, most important determinant of your portfolio success. This kind of all came out of a lot of the modern portfolio theory, academic work that was done in the 60s and 70s and even before that, some of it. And there was one measure that said, like 96% of the portfolio's return is going to be based on the asset class choice, not the individual manager or the individual stock selection. So whether you're in mid-cap value funds versus bonds, for example, instead of picking Apple over Microsoft, is going to be the big thing. And most people spend their time talking about individual stocks. And I say this later on, turn off CNBC. We've actually turned off CNBC in our office because it's just noise. There's no information that is going to come there that's going to help you. It's so much more likely to have you do something that's detrimental.
The Inquirer of the financial services industry. Yeah. It really is.
There's some interesting information, but you have to be careful not to react too much to it. So the pyramid on 18 kind of shows, the most important factor is the asset allocation. Those other factors, like picking individual stocks, is very small part of the return. Now this thing that looks like the periodic table of the elements, this is...
But I can't read any
I know, you can't, I can't read any of it either, but each color is a different asset class. The red is large cap growth, the white is 3-month T-bills, to give you an idea. And on the top line, across the top, that was the top performing asset class of these asset classes for that year. So where you see the 4 red blocks, 95 through 98, that was the tech market, where large cap growth, driven almost exclusively by 3 companies, Microsoft, Cisco, and Intel, just crushed the rest of the market. It wasn't just that they were on top, it was like they were 38% up versus 5% in T-bills. It was such a huge differential that even professional investment managers started saying the rules have changed. It's a new economy. Remember hearing that? It's a new economy, the rules have changed. You don't have to do asset allocation anymore. You just put everything in these big tech companies. And many, many people did. And of course, there you see those asset classes falling to near the bottom after that. And other than that, it's pretty random. The point is that it's a pretty random distribution. You could look at taking the worst one after the end of each year and buying that. That doesn't always work so well. That works a little better, studies show, but not a whole lot better. Another interesting statistic is over this period, this is a 20-year period on this particular table, Mutual funds kind of overall returned about 11% annualized. The individual investor, based on different studies, earned between 4 and 5% because they were in and out of the wrong things at the wrong time. So if you just bought and held this whole mix evenly split, you got about 11% return. And that's the emotion doing the most damage to your portfolio. So what you do when you're trying to build a portfolio is you break it down into basic asset classes, and I would say cash and cash equivalents is one. You might even throw that in with bonds and call it fixed income, but cash could be considered a separate asset class. Bonds, stocks, and I put alternatives here, and then down below there's a list of what alternatives is. I think it's become pretty much conventional wisdom now in the investment world that you would like to include alternatives in your portfolio if you can, and it is much easier to do so than it used to be. Just 5 years ago, it was very difficult to get exposure to many of these alternatives without investing in a hedge fund or a limited partnership or a private placement. Now you can get pretty much all of these strategies through a liquid mutual fund or exchange traded fund. So you can get in and out without a lot of cost and hassle and tax consequence. So an alternative is a non-correlated asset, meaning it shouldn't move along with stocks and bonds. Stocks and bonds don't, sometimes people think that stocks and bonds move inversely, and that's not necessarily true. There's not a direct correlation there with stocks and bonds, but they tend to move a little differently. And then alternatives move even differently from those two asset classes.
When does gold go up? When everybody's depressed. You know, the world's going into hell in a handbasket. What's going up? Gold. So, you know.
And is it a good time to buy gold now?
No.
I mean, it's set at all-time high. You know, it may go higher, but you know, you want to look in longer-term periods. So ideally, you want to include some of these non-correlated assets. And the idea is that when you put together this mix of asset classes, a well-balanced portfolio at any given time, some things are up and some things are down. If everything's up, you don't really have a good portfolio because it's not going to weather all markets. It may feel good, but that's not what you want. You want a well-diversified, some up, some down, that are not moving in tandem. So we have assets in some of these things that we don't really even, some people who are really, really negative about the outlook, which is not how we feel, but we have some of those type of funds because we could be wrong and they move differently from the market.
And in alternative asset classes, what percentage of a person's equity portion of their portfolio do you usually put this in?
We don't pull it out of the equity portion directly because some of these alternatives could arguably are more bond-like and some are more equity-like. So some are meant, I mean, they're meant to diversify, number one, but on the other purpose is some are meant to stabilize and some are meant for some extra growth. So you could break them down into some into fixed income and equities, but of the overall portfolio, I would say 10 to 20% in alternatives.
That doesn't mean you put all your eggs in that one basket, but 20, and that's high.
That's high, 20 is high.
20 is high.
15 is probably a
Yeah,
number.
you know, my sister does real estate and apartments, and she stays away from the stock market. But can you invest in the stock market just in apartments and income properties? Absolutely.
Through real estate investment trusts and
Really?
mutual funds of real estate.
Yeah. So, and she knows them, so she knows how to run an apartment complex. So I said, hey, if you want to invest in some other real estate, find out the general partner. Find out what kind of properties they have. Go visit some of the properties. See what you think of management. And if you feel good about the management, then you can invest some monies in it.
So the process is determine which asset classes you're using, you know, cash, fixed income, large, mid, small stocks, and international stocks, and bonds, for example. And I'm not even going into bonds because bonds you can break down like you break down stocks, different types of bonds, different maturities of bonds, etc. But I'm just going to put that in one category for today. So first of all, the first decision is really the mix of stocks and bonds. and bonds and cash being in the same category.
And we went through, David did a formula with the Bagan portfolio based on age and also just a questionnaire.
Okay, so the 80-20 or 60-40 or whatever, and then the asset classes of stocks, and the thing that we haven't talked a lot about is international, and that could be a whole class in itself. Do you really pull out international as a separate asset class? And I think most investment people do, though there's some pretty good arguments for not doing that, because if you're investing in the S&P 500 type companies, I think most of the revenue, more revenue than not, of the big companies comes from international operations. You could argue that you have a very international portfolio just by investing in the big multinational companies.
In the international portfolios for your clients, international is approximately what percentage?
Depending on the model, I think 6 to 22%
Okay.
right now.
Gives you a little range.
We do
So
pull it
you
out.
may want to take a look at your own portfolio, that you may want to have something in there at least 6%.
And you can break out the internationals the same way: small, mid, large, value, growth, or you could pick a active manager that's going to make those calls for you, a mutual fund that can go into all those different areas, or you could buy index funds that cover those different areas. So there's lots of different ways to build that portfolio. So you want to look at domestic versus international stock, you want to look at growth versus value, and you could buy an index that covers both growth and value, so just buy one fund, or you could buy an index for each one, which is kind of redundant if you could buy the one that covers both, or you could buy an actively managed fund that manages in those different categories. So the catch is, if you're building this with the actively managed funds, you really want to feel confident that you have a manager that is going to beat their benchmark, beat the area of the market that they're investing in, because you're going to pay probably 1% more, whether it's a load fund or a no load fund, whether you're working with an investment manager or doing it yourself, versus buying the index or the exchange traded fund. So you could buy a large company blend mutual fund, a manager who has a great record, a great reputation, and pay 1%, or you could buy the S&P 500 exchange traded fund for 0.08%. So you have to be sure that that manager is going to give you at least 1% a year more in value.
You can go to Vanguard and buy the total market index fund. It's made up of 5,000 stocks, and you can buy it for 18 basis points per year. You got the top 5,000 companies in the United States. That's diversification.
Yeah, that is the simplest way to do it. Put your 60% in stocks, buy that fund, and do bonds with 40%. I mean, it's a really simplified way to do it.
And you probably
Not all bad.
outperform
Most
people.
Most investment managers, most investment managers are outperformed by the index.
And that's the big secret.
Yep.
That anybody can do this. And that's why they don't put on your brokerage account what your percentage rate of return is. And that's why they want to keep on putting, it is such big money. I mean, it's
and the
huge.
whole idea of benchmarking is that there's a lot of games played with the benchmarking, because tell me, I can pick any benchmark. If I can pick the benchmark, I can pick a benchmark I can beat no matter how I'm investing. A lot of playing around with the benchmarks. And benchmarking most portfolios to the S&P 500 doesn't make sense unless you're 100% invested in stocks. I mean, you're not trying to, you shouldn't, nobody hardly should have a portfolio that's trying to beat the S&P 500.
How are we doing on time?
It's too risky. So diversification, just by employing the asset allocation approach, by buying mutual funds or index funds, you're going to have some diversification. If you are putting together an individual stock portfolio, there are studies that show really you lose diversification value after about 20 stocks, certainly after 50 stocks. Adding more stocks doesn't change the risk profile and doesn't increase your diversification. 20 is kind of a small number, though we like that when we do occasionally buy actively managed funds. We like, if we believe in a manager, we'd like to see a concentrated portfolio. We'd like to see the top 20 ideas and not 80 stocks that they're just throwing in there. You know, that
It's
they
just
really
that-
have conviction in those
Yeah,
companies.
an individual could study reasonably 20 companies. It's much more difficult to study 80 and stay on top of them. So if you're going to believe in a manager, then, you know, the Warren Buffett approach, get to know those companies that you're investing in and get them to know.
Right, and we'd rather have a manager's top 20 picks than, you know, 80 thrown in there with the top 20 because it's diluted. The top 20 are then diluted by all the rest that's in the other stocks.
So your first choice, you know, when you pick an investment advisor or a financial planner, one of the things is to ask them, do you believe in indexes or do you believe that there's people out there that can beat the index? And there's whether you choose one or the other, that's not a wrong choice. You know, it's personally how you feel. And so there are excellent ethical advisors out there who believe that there are managers who they can pick out who will perform better than the index. You know?
And you need to understand the philosophy and it needs to make sense to you.
Yes.
And I always, my firm jokes about it, and they could probably change my mind about how we do things because there's so many different ways you can do it, but you have to stick to it. And that's the problem. The people who always believed in asset allocation threw it out the window when the tech market was running. I mean, if you stayed in your asset allocation model, you did fine during that time period. But you didn't have the years where you got 50 or 60% returns.
Yeah, there was
People abandon their philosophies. Investment managers abandon their philosophies at the worst possible time in many cases.
Yeah, there were value managers in the .com area who went broke here in Newport Beach that were huge firms because they were only getting 8 to 12% return per year. Remember the .com? I mean, people were talking 30%. I mean,
I got fired on a defined benefit account, which is supposed to be a pretty conservatively managed account, for 16% annualized return over like 5 or 6 years. And that was the one I remember the most.
Yeah, and it works in reverse too. You know, I mean,
Right.
I can't stand it any longer. I mean, the market is going down. In 2008, I mean, people were dropping out of the equity market like flies and leaving their advisors and saying, I can't hold this position any longer. I only got a few more years to live and I want to see some monies in there. You know? So it works on the other side too.
And the key is with the asset allocation approach, you know, you're never going to be the top performer, but you're never going to be the bottom performer. It's a way to smooth out the ride. You're always going to be in the middle.
So what
And I
is
think
this?
if you've been through a bad market, the middle doesn't sound like such a bad place to be.
Moderate growth.
So this is just, actually pulled this off of the Laguna Beach Community Foundation's pools. This is
By the
one
way,
of our investments.
Laura is the chair for the Laguna Beach Community Foundation as well.
Little thank you. Little pitch for the Community Foundation. But this is one of our investment pools that if you have a donor advised fund at the Community Foundation, this is one of the choices for investment, is our moderate growth pool. And actually it says there in small writing the expected long-range annual return it's probably 7 to 8%, 9% might be pushing it with this allocation, truthfully. Based on past, that's certainly true, but going forward, probably be a little more conservative there. But this is how that pool is split. And we have a passive approach. We use really, really low-cost exchange-traded funds to implement that, to keep expenses down. And if we get the returns of these asset classes, which you do by definition, get the return of the asset classes if you're investing in the index, we're going to be very happy because those returns have been very good over time through all markets. And this is a standard endowment model type investment, 40% fixed income, 60% in equities. Though we do have riskier pools at the foundation. That's one of them, and more conservative pools. You've seen this next chart probably. Unfortunately, I don't have a more updated version showing the last couple of years, which is kind of interesting. But in the scheme of things, still just a blip on the long-term record of the market. And this is kind of the argument for why you do need to be invested at least partially in stocks. Over this, how many year period? many year period, 80-year period almost, inflation has averaged 3%. And that includes some periods of very low inflation and those really high years of inflation factored in there. And with a group of advisors the other day, we were discussing the inflation, and we were pretty much in agreement that the world has changed and the economy in the United States has changed enough that it's probably unlikely that in the next 20, 30 years we're ever going to see rates of inflation as high as we did in the early 80s, for example. We will see higher rates than we have now, but
what do you mean by rebalance on the slide below?
Rebalancing means that you are, if you say that you're going to follow a model like this moderate growth model on the other page, and you want 9% in small cap stocks, and small caps run, and you do this analysis, and now your small cap allocation represents 15% of your portfolio. Well, you need to sell small cap and buy the thing that went down. So rebalancing is just rebalancing it to your original model, which sounds really easy, but is very hard to do because you're going to sell the thing that's doing well, and you're going to buy the thing that's not doing well. I mean, that's what you're supposed to do. Buy low and sell high. It's really difficult to do.
And how often do you look at your client's portfolio to rebalance?
We're looking at it daily, and we're addressing it with cash flows and taxes. But if you're just looking, if in a static portfolio to rebalance for individuals, I would say twice a year is good. Quarterly, we do it formally.
But at least do it once a year.
Or you could say, I'm going to do it if you get a certain amount out of balance, 10% tolerance band. I mean, there are lots of different ways you can do it, and that really doesn't make a lot of difference. You can look at one of these portfolios, run it out for 20 years, just the fixed mix, and then you can look at it rebalancing it quarterly, you can look at it rebalancing annually, and it doesn't make a lot of difference. It makes a little bit of difference, rebalancing, but it's amazing. It doesn't make a lot of difference.
But it feels like you're doing something.
Right. And it is the buy low sell high. When we take profits from a position, we always get calls from clients who say, "Why are you selling that? That's up the most in the portfolio." Exactly. That's the point. And we're going to buy that thing that you don't like right now.
God, it's amazing that you even keep any clients.
Tough discipline.
Performance.
I want to just a couple more comments on this chart, just to notice the differential between large stocks and small stocks. How much better small stocks do over time. The other thing that's always interesting about this chart is it's a very long time horizon. But the difference between 1% and 2% over the long term makes a pretty big difference. And so I think about that when I think about paying maybe an extra 1% of some kind of fees on your portfolio. Over time, that makes a huge dent in the amount of money that you have. So as far as monitoring, you do need to rebalance. I have here turn off CNBC. Don't pay attention unless you are trying to track individual stocks. You don't need to pay attention to the day-to-day, which is another reason not to have individual stocks unless you really are able to watch it. You're able to take action immediately. You're not on vacation when the bad news comes out or something like that. Lots of difficulty in individual stocks, and stop losses can really burn you. People just think, I'll just put a stop loss on it. You could get whipsawed. If there's a flash crash or a piece of bad news that's not really bad news, which has happened a couple times, and the stock tanks and you're sold out, you can't sell quickly, and it sells out at the bottom and it bounces back up and you're out at the bottom.
Yeah, stop loss does not mean that you get to buy it or sell at that price. Whenever it gets below that price and somebody's willing to buy that share, that's the price you're going to get.
And there are all kinds of hedging strategies, very complex strategies, complicated products that the financial services industry has put together called structured products, where you could say, I want to buy the stock market, like the S&P 500 index, and I want to have no more than a 10% downside, and I'm willing to, accept that if I can have capture 60% of the upside, and you can build all these specific parameters, and they'll build you this partnership. And it's just when you do the analysis on it, and it costs you, of course, to buy that. There's a cost to buying that. It's just not worth it. You're just better off having a diversified portfolio.
Bob Citro, remember Bob? Bob was with two guys from Merrill Lynch. And Bob was excellent in the fixed income area, picking out CDs from across the country. But he could only buy fixed income areas, fixed income for the Treasury. And so he went to the Merrill Lynch. Merrill Lynch says, I got a secret sauce. And he says, we can give you the fixed income, but we're going to give you the fixed income based on the rise of the stock market. It's a derivative. Okay? And he got totally involved and had no clue to what he was doing. And when he went to trial, what was his defense? Ignorance. And it was really, really true. He had no clue. The mortgage industry, you know, the AIG up in England, they had a group in the back room doing all this, figuring out how secure these mortgage-backed securities was. The CEO and the rest of the company had no clue what they were selling.
Well, sometimes they did. If you look at some of the internal memos that come out, they know that they're tricking people, ripping them off. I mean, it's horrible.
Yeah, so there's that part too. But there is, you know, the whole idea that there's something magical out there that'll get a better return than you can is false. And as soon as you start getting into these little secret things, whether they be hedge funds, and hedge funds by now, today, are the hot thing.
Right, or exclusive, or something that's only available for the next 2 weeks that's closing at the end of the month. That still goes on.
Yeah.
It's just crazy.
It just gets a little more sophisticated than the pinochle, you know? Guess what shell the pinochle is on? It's just a little bit more sophisticated than that, but it's the same game. Let's go to
performance measurement.
Yes.
There are different ways to report performance, and it says here the most common is none, and that would go for mutual funds, your 401k statements, so they're getting better, and what you do yourself, and even some investment advisors don't report performance. And when you're buying different mutual funds, the track record of the mutual fund isn't your performance. You need to know what the performance is from the day that you bought it and the day that you sold it. And that's what I said for the 401k plans, and some of those are getting better at actually calculating your return, which is very cool. Because it isn't that straightforward when you have cash flows in and out. I mean, you really do need some complex software to accurately calculate that. The way that investment managers are supposed to report their performance is on a time-weighted method. And what that does is it discounts, or it takes out the effect of any cash flows in and out of the portfolio, so that I, as the investment manager, don't get credit for the fact that my client added $1 million to the portfolio the week before the market went up 20%. So it discounts that and takes out that to even it, so you have a linked series of returns regardless of how much money you have in it. So that's the best way to compare managers. The dollar weighted, also known as the IRR, the internal rate of return, is really the more accurate measure of how you did, because the fact that you put $1 million in before the market went up, that benefits you and that affects your return. It's just that the manager shouldn't get credit for that. So the IRR is actually more your true rate of return, where it takes into account the cash flows.
It could very easily, Smith Barney, Merrill Lynch, no matter what the brokerage firm is, could easily give you a rate of return performance-wise. None do. Your monthly statements are literally just a snapshot. They're no good for anything. Just tells you how much you have there. That's it. Doesn't tell you how you're doing comparing to the indexes most times. It doesn't tell you whether or not you're meeting your goals. It doesn't tell you how much risk. Lots of times it doesn't tell you exactly how you're diversified. It doesn't include an investment return in it, because if you take money out or you put money in, that number shows as a loss or as a gain for the entire portfolio. So most of the brokerage firm's statements, and they give you stacks of paper, by the way. The more paper they give you, the less understandable it becomes for you.
And what you should be looking for as far as rate of return, what we tell our clients, we want our clients in the most conservative portfolio that's going to meet their goals. I mean, you don't take more risk than you need to. Okay, that doesn't tell you too much because, you know, some people will say, well, I want to spend as much as I can. It's all related to spending, especially when you stop working. It's like how much you're going to spend is going to determine what kind of rate of return you're going to have given a fixed amount of assets. But we will tell people, you know, given a reasonable spending rate, you don't want to take more risk than you need to in most cases. Some people are just very comfortable with the risk and they'll say, it's okay, I don't care, I'm going to be a little more aggressive and growthy. But generally, only what you need to meet your returns. And then, so you have your own rate of return. And maybe it's a 7% return long-term that you need to meet your goals. And then that's what you're trying to get. You're not trying to beat the market. You shouldn't be trying to beat the market.
So you need to know what your sweet spot is. What is it that gives your portfolio comfortable? How can you make sure that you feel good with not running out of money over the rest of your life?
And where a financial advisor can help you is if you do that calculation, you say, okay, I'm retired, I have this much, and I spend this much, and we run the numbers and say, okay, that means you need a 13% rate of return. We'll say, you know, that's not reasonable. That's too much risk. That's too high a rate of return. So you either need to go back to work or cut your expenses. I mean, there's all those different moving parts, and you can adjust any one piece of that. But that's really important to pay attention to. So you know, what rate of return do you need to get to make sure that your money lasts? You know, are we going to plan on you selling your house and spending that asset at some time? You know, hopefully not. All those things have to be thrown into that mix when you're looking at what you need on your portfolio. So the ultimate goal on the pyramid there is consistent risk-adjusted investment returns. You know, a smoother ride, I think, is what most people want. Your risk reduces the longer you are invested. And the point is you shouldn't invest any money in the stock market at all if you need it in the next 1, 2, 3 years. Any money that you put in the stock, if you put a portfolio in, you know, maybe you can draw some of that money, but if you need to take it all out, you shouldn't even be in the stock market. Assuming that most of your portfolio is going to be invested for the long term, you need to look at those long-term periods. You know, if you're going to be around here for 5 or 10 years more, you know, that's your horizon, and look how your risk reduces over time. So this shows you that if you're investing in small stocks, the dark blue bar, over any one period, your return could be as low as, based on the last 100 years or 80 years, it could be as low as 60% negative. It could be as high as 150% on the upside. But if you are invested over 20 years, there are no down periods in small stocks. And your compound annual rate of return is going to be 11.7 over that 80-year period. So the range gets much tighter the longer you are invested. And that goes for all the asset classes. So that's how risk reduces over the time horizon. And then the bottom chart is very similar, showing the percentage of times over 1-year periods when we can expect a down stock market. And that's what we tell people. It's like about a little more than 25% of the time we can expect a down year. It's a normal thing. It's an expected thing. It's a healthy thing. But over any 5-year period, only 14% of the time is the market down. And over any 15-year period, the market is not down over that time. And I think that even holds for the period with the whole bad market that we've had. I think 15 years is the time period there. So the longer your time horizon, the more you can stay invested in the stock market. And you should always have enough to meet your living expenses if you're drawing from your portfolio for 2 to 3 years, so that you don't have to sell stocks if the market's in a bad place when you need to pull out money.
And that's why also the reason is that for most, even for very conservative folks, they may want to have 20 to 30% exposure to the stock market just because that's what's going to give you some kind of inflation hedge.
Yep.
You know? But if you're going to worry about it, you're going to fret, and I'm going to demand that you be like my mother and stick with CDs, okay? Because you're going to live longer having less stress if it worries you. So, because what are you going to, if the market goes down, even if you have 20 to 30% in the market, what are you going to do with that 20% when the market goes down?
Lock all the windows.
Yeah, and you're going to sell it. You know, and so that's just the wrong thing to do. So you got to kind of be.
And you need to know what that means for your burn rate, what you can spend. We have clients who just cannot tolerate any risk, and we've had to calculate and say that's fine. But then that means you're limited to spending this much. You're not going to have any growth. And it's very challenging finding yield in this environment. So if you have enough money and your spending is reasonable, you might be able to afford to do that.
So you got to look at your own personality. You know, this is about almost self-analysis. You know, is it a manager index? Can you do the stuff? Will you sell at the wrong period of time? How emotional involved are you? I think it took me a major loss in my portfolio before I could give up control of my portfolio. Because control is a big issue. Is that I mean, for most of your clients, they give you the right to make the trades, right? Do they feel like they've lost some control?
Yep, people who haven't done that before, it's tough.
Yeah. So it's...
But also I do see people that, I mean, there's like a kind of a pattern that I've seen where people retire, they have a little more time, they think this is an area that's interesting, they learn a little bit about it, they get very involved in it, and then they get over it. Either through a loss or it gets crazy. It just gets, you just kind of start to see the futility of trying to figure out the best stock. And it's time consuming, and for most people it isn't that interesting and fun after a while.
Let's go to the last slide.
So investment philosophy and style. So you need to see what you're comfortable with or find someone who works with a philosophy that you're comfortable with. It could be an asset allocation, it can be passive, that could be passive or not passive. There could be a market timing philosophy that you believe in, though be careful because that sounds very compelling that someone's going to get you out of the market at the right time. You know, if you believe that's possible based on what you've been hearing here and other places, then stick with it. Active management can involve fundamental or technical analysis. You can do it yourself or hire a professional. As I said, the do-it-yourself, you can keep it really simple with index funds at a company like Vanguard and pick a good mix, and you won't be too far off from many of the professionals.
Yeah, and if you hire a professional, I think hire somebody who's fee only, please. And or discuss the fees and expenses with your broker, and so that you understand exactly how they're getting paid.
And most people aren't going to call themselves a broker. Most brokers aren't going to be calling themselves a broker. We've been through that: financial consultant, financial advisor, investment manager. All those terms are just made-up terms.
I just got, there was an article in the newspaper on Wells Fargo. Wells Fargo is a bank, correct? Okay. Do they have any other divisions?
Yes.
What? Do they own a broker-dealer?
Yeah.
Yeah. Do they have a mortgage department?
Yeah.
Do they have a reverse mortgage department?
Yeah.
Is there any product in the financial services industry that they don't sell? They sell everything. And so there was an article in Investment News yesterday, and it's said that Wells Fargo has made more money this last quarter than they have in any previous quarter. But the CEO, that's not what he was most proud of. What was he most proud of, you think? That the percentage of cross-selling had increased by an entire %. What cross-selling is when you go into Wells Fargo, and not just picking on Wells Fargo, it works almost to most banks. You go up to the teller and you go, gosh, I want to renew my 5-year CD, and then they tell you it's a 0.5%. And you complain to her and she goes, oh, why don't you go see the nice man over here at this desk, and he can help you with the Golden Age retirement plan. When what he's selling you is an annuity. What you don't know in the background is that teller is going to get a referral fee to the financial advisor in there. The branch manager gets a cut of everything that gets thrown out there for a mortgage or a reverse mortgage. The personal banker gets rewarded for every referral that goes out to every single different slice of Wells Fargo. When you walk into the bank, you're walking into a supermarket. And everybody there should have a sales tag. I work for Nordstrom's, really. Okay? But they don't look like salespeople. And so the number one thing, I thought it was interesting that he would even state it, that the cross-selling that goes on in these industries. And that's why I asked a question of all the financial advisors. Do you accept or give referral fees?
I have mortgage people all the time willing to pay huge fees for referring their mortgage business.
Yeah. The mortgage people that work for Wells Fargo, for example, do not work for a salary. They're strictly on commission. They give them their desk. If they don't sell X amount of reverse mortgages, they're gone.
And the company pays millions of dollars to bring in the top salesmen. I mean, the bonuses that they pay to bring these people over.
And you don't start getting a
really
bonus.
Well-trained salesmen.
Yeah, you don't get a bonus. And if you start in a reverse mortgage, your first reverse mortgage that you sell, you get 20% of. You have to sell 5 reverse mortgages to get up to the 50% commission level. Who gets the other 50%? It's got up between the branch manager and corporate. There's also additional fees in the reverse mortgages. Where does that go? That goes to Wells Fargo as well. But financial services industry cannot make the billions and billions of dollars that they do on fees. It's commissions that drive everything. And so just be careful out there. You know, the 3-piece suit or the nice person. Use the Ask First form. And get at the nitty-gritty. Find out how they're licensed, how they're paid. Laura, you did a great job.